the first definition that we're going to look at is that of a company, which is a business enterprise different from a sole trader or a partnership. A company is created by a person or association of people, and a key characteristic is that it has its own separate legal identity. When you look at a company, I want you to imagine a building. There are two different types of companies. You have a private or a public company, where public companies must be listed on the JSE, which is not necessarily the case for a private company. Now, how or where do you register a company? If you go to www.cipc.co.za, you get the Companies and Intellectual Properties Commission. That is where you register a company. And at the end of the registration process, you'll get a memorandum of incorporation, which is a set of your basic rules. So when you look at the building, the pieces of the building in a company, you would call them shares. Now, the owners of the pieces of your company, or i.e. your shares, are called shareholders. Now, when the company gives out at a certain price or value pieces of its own company, that value is called the share issue price. Now, when we look at the concept of separation of ownership and control, shareholders are the owners of a company, right? They just own the company. Whereas the board of directors is a group of people who manage the daily operations of a company. So that is what we look at when we talk about separation of control and ownership. The board of directors are the ones that have the control of the company. Then once you have set the financial statements for the year, you have these big people that come and check if you've set these financial statements correctly, and that is what we call your auditors. So when you register your company at CIPC, there's a section where they'll ask you how many shares do you want your company to have. That is what is then called the authorized share capital. Once you've registered your company, let's say you've chosen 500. That's the maximum amount that is authorized by your company to have. Then if you want other people to buy into your company, or you're giving out shares for people to buy, that is the issued share capital. The amount of shares that you have issued to other people that you as the company no longer own, that is called the issued share capital. The distinction between the two becomes very important later on.